In the derivative market, the value of contract is based on the price of an asset which is referred as. The value of contract is based on the price of an asset which is called underlying. Futures, forwards, option underlying. The answer is D. Which of the following is not which of the following is not considered a function of financial market? Allocating savings into productive investment, no. Determining the valuation of security, no. Increasing the risk and liquidity of financial assets, yes. Reduction transaction cost. So which is not considered a function of financial market? So the answer is C. Who is the main stakeholder in financial market? Brokers, no. Underwriters, no. Merchant bankers, no. Companies. The answer is D. Which entity earns profits from the price difference between the pre-IPO purchases and the public offering price? Merchant bankers, custodians, brokers, underwriters. So the answer is D, underwriters. Which organization act as a self-regulatory body for the bond, money and derivatives markets? FEDF, Foreign Exchange Dealers Association of India, no. Association of Investment Bankers of India, no. Association of Mutual Funds, no. Fixed Income Money Market and Derivative Association. The answer is D. Why are SPACs commonly refers to as a blank check? Because investor must provide blank check to the companies they invest in, no. Because investor do not know the acquisition target in advance, because investor have knowledge, complete knowledge of acquisition targets, because investor have partial knowledge. So the answer is B. Which of the following statements is accurate regarding SPAC? A cell company generally has a strong history of profitability. B. India's M&A activities are significantly superior to those in developed countries. C. The sponsor must identify an acquisition target within 2 years and complete the purchase. D. SPACs are an investment model exclusive to the United States. So the answer is C. What is the primary purpose of the green shoe option? To determine at fair market value, no. To stabilize stock price, yes. And allow over allotment of shares, yes. To increase IPO valuation, no. To facilitate book building, no. So the answer is B. Reverse book building is mainly utilized for IPO, FPO, the process of delisting of a company, securing investment from anchor investors. So the answer is C, for the process of delisting. If the price band is adjusted during a book building issue, the binding periods can be extended by maximum 7 working days, 10 working days, 12 working days, 15 working days. So the answer is B, 10 working days. What is minimum investment? What is the minimum investment required for an anchor investor in a public issue? 10 crores, 15 crores, 20 crores, 25 crores. So the answer is B. 10 crores is the minimum investment required for an anchor investors. In an IPO, what portion of the anchor investor is allocated is reserved for the domestic mutual fund? 50%, 33.33%, 25%, 20%. So the answer is B. One third is reserved for the anchor investors. So one third is 33.33%. Which of the following does not qualify as a risk management practice in the secondary market? Establishing trading rules and regulation for broker members, implementing market surveillance to control excessive volatility, setting up a trade or settlement guaranteed fund to ensure timely settlement in case of default, no. Creating a clearing corporations that settle transaction and a depository that only guarantee financial statements. So the answer is D. What is being asked? What does not qualify as risk management? So the answer is D. Rest all the three is qualify. What terms describe the process of separating the ownership and control of a stock exchange from the trading rights of its members? Indexation, no. Demutualizations, yes. Trading mechanism, no. Government governing boards, no. So the answer is B. Which of the following is not? Which of the following is not considered a risk management tool in secondary market? Circuit breaker, no. Rolling settlement, no. Reverse book building, yes. Market making system, no. So the answer is C. If a security is lent at 500 and its transaction price are 500.5 and 499.5, what are the lenders earning as a fee and borrowers rebate earning? So the lenders earnings is 500.5 minus 500, so the 0.5, but the fees rebate earnings each 500 minus 499.75, that is 0.25. So the answer is A. A security has a securities lending price of 100 and its transaction price is 100.35. If the borrowing period is 10 days, what is annualized yield? So annualized yield will be 100.35 minus 100. So the answer is 0.35 for 10 days. So 0.35 into 365 divided by 10 days into 100, that is 12.78%. Stocks that are highly liquid have higher margin requirements, no. Have low liquidity, higher margin requirements, yes. Highly liquid, no margin requirements, no. Have low liquidity, lower margin requirements, no. So the answer is B. Stocks that have low liquidity have higher margin requirements. So the answer is B. If a T+1 settlement cycle is implemented, which risk will be reduced for both clearing corporations and foreign portfolio investors? Credit risk, no. Liquidity risk, no. Counterparty risk, yes. Market risk, no. So the answer is C. What is the effect of reducing borrowing amount for treasury bills on their supply? Increase in supply, decrease in supply, increase in demand, decrease in demand. So the answer is B, decrease in supply. A certificate of deposit has a face value of 5,000 and a 6-month maturity period with a 10% discount rate. What is the issue price? So the face value is 5,000 and 6 months maturity and 10% discount rate. So 5,000 into 10% into 6 by 12. So it's 250. 5,000 minus 250 equal to 4750. So the answer is C. Based on the previous question, what is the effective rate of interest? So the effective rate of interest is 10%. So the answer is A. What terms refers to the market? What terms refer to the market for loan with extremely short durations ranging from 1 day to 14 days? So 1 day to 14 days is called call or notice money. Treasury bills, no. Calls or notice money, yes. Repos, no. Commercial paper, no. So the answer is B. Which of the following is an unsecured? Which of the following is unsecured promissory note? Treasury bills, no. Commercial paper, yes. Commercial bills, no. Repos, no. So the answer is B. The maximum duration for the transaction in the call money market is 7 days, 14 days, 21 days, 30 days. So the answer is B. 14 days is the maximum duration for transaction in the call money market. A depositor places 1 lakh in a bank. According to the current RBI regulations, how much must the bank keep as a cash reserve ratio, CRR? So So the currently CRR is 4.5%. 1 lakh into 4.5% is 45. So the answer is A. What are the respective names of bonds issued by the central government, state government, and corporate entities? State bonds, sovereign bonds, corporate bonds. So the issued bonds issued by central government is called sovereign bonds. Bonds issued by state government is called state bond, and corporate entity by the corporate entities is called corporate bond. State bond no, national bond no, sovereign bonds yes, state bond, corporate bond. So the answer is C. If a bond is required yield drops below its coupon rate, how will it be traded? At par. So when the required yield is drop, so the price of the bonds increases. So required yield drops below its coupon rate. So at par, at discount, at premium. C, at a premium. Which type of financial instrument? Which type of financial instrument carries the least default risk? So treasury bill is the safest investment, risk free. So the answer is A, treasury bills. Identify the incorrect statement. Identify the incorrect statement regarding bond investment. Incorrect statements. Okay. The longer the maturity period, the less sensitive the bond's price is to changes in the market interest rate. The bond value and interest rate share a non-linear inverse relationship. Yes, this is correct. Bonds with higher coupon rates tend to be less sensitive. Bonds with higher coupon rates tend to be less sensitive to interest rate fluctuations. Yes, it is correct. If a bank interest rate exceeds the bank's coupon rate, the bank traded at discount. Yes, it is correct. So the answer is A, that is incorrect. Why are corporate bond less liquid than money market? Why? They are asking the reasons. Money market instrument and corporate entities. They are long-term securities which are riskier and less marketable. Yes, it is. Corporate bonds are marketable as money market instrument and equities. No. Money market instrument have a smaller denominations. No. Corporate bonds are not tax exempt. No. So the answer is A. They are long-term securities which are riskier and less marketable. In which market are new bonds and stock first issued and sold to investors? Primary market, secondary market, auction market, stock market. So in which market are new bonds and stocks first issued to and sold to investors? So the answer is A, primary market. Government security with maturity exceeding 1 year. Maturity exceeding 1 year known as government bond, treasury bills, bills of exchange, commercial papers. So the answer is A, government bonds. It's generally a long term. The call option value of callable bond is higher. Call option value of callable bond is higher when interest rate are low and expected to stay low. No. Interest rate are high and expected to remain high. No. Interest rate are highly volatile. Yes. Markets are inefficient. So the answer is C. Which financial concept measures bond sensitivity to interest rate fluctuations? Which financial concept measures a bond sensitivity to interest rate fluctuation? Durations yes, YTM no, current yield no, none of them. So the answer is A. Primary dealers primarily trade in which type of financial instrument? Bond, mutual fund, government securities, debentures, government securities. The answer is C. What is another term for an irredeemable bond? Fully convertible bond no, perpetual bond yes, it's a irredeemable bond. Partial convertible bonds, no, none of the above. So the answer is B. Floating rate bond have fixed interest, variable interest rate, zero interest rate, none of the above. So floating is variable interest. When risk perception is high, investors prefer bond with higher interest rate, lower interest rate, par value, none of the above. When risk perception is high, investor preferred lower interest rate bonds. So the answer is B. Investors generally demand what kind of returns for the bond with longer maturity? Lower interest, higher interest, zero interest, none of the above. So the answer is B, higher return. The fixed interest rate stated on a bond at issuance is called fixed interest rate. Bond rate, repo rate, coupon rate, all of the above. So the answer is C, coupon rate. What does marketability risk of a bond refers to? Market-wide risk affecting all bonds? No. Variation in terms caused by challenges in selling stocks? Yes. Failure of an issuer to meet payment obligation? No. Both no. So the answer is B. A bond issued at a discount and redeemed before maturity is called mortgage bond, zero coupon bond, convertible bond, all of the above. So the answer is B, zero coupon bond. Bond is issued at discount. Generally, zero coupon bond is issued at discount and redeemed before maturity. What is bond that can be redeemed before its maturity? Called callable bond, option bond, step-up bond, non-callable bond. So the answer is A, callable bonds. What does bond duration measures? In relation to interest rate change, sensitivity of yield, sensitivity of YTM, sensitivity of full bond price, yes, sensitivity of convexity, no. So the answer is C.